I'll just introduce myself. I'm Ben Butler. I'm a financial planner for Perspective. Okay, it's just a bit about us. We're based in the Milton Keynes office. There's a couple of us here. You might recognise Chris. We've got on the table just over there. But that's the team as it is at the moment. We're just by MK Bowl, if you know the area. So pretty central. Okay, so who are we? What do we do? So we're financial planners. Okay, so I'm a member of the Personal Finance Society. Our company, we're growing quite rapidly. Last year, we had a purchase for every month of the year of different businesses. So in total, we've got 23 offices, 300 staff, and under one name or another, we've been going for 30 years now. Thank you. In terms of split of who we work for, about 80% of people are individuals, okay, and the other 20% are business owners and companies. Okay, there's a little bit of a difference, obviously, between working with each of those, but that's something we can go into a little bit later. Okay. Personal finance, financial planning, what is it? There's quite a bit to just managing your money, your finances, savings, etc. I won't read through the presentation, but essentially those are a couple of them. Can you read that? Is that big enough? Is that all okay? Fantastic. So the main aim for us really, and our bread and butter, is retirement planning. Okay, and whether that's preparing for retirement, going through that big milestone of your life, or once you've retired, being able to manage your money through those wonderful years that you've been working for decades to get to. Retirement planning's changed quite a bit over the past 20 years. Quite traditionally, even before I was born, the go-to method of retirement was to take your pension savings that you've been looking after and growing throughout your time at work and to use that to purchase an annuity. Now, due to low interest rates we've had over the past 15 years, that's gone quite out of vogue, and it requires a lot more upkeep and managing, etc. So that's mostly what we do, but that's part of the bespoke service. So essentially, we look at every aspect of your life, whether that's investments, so your ISAs, general investment accounts, we've got your protection, so life insurance, critical illness insurance, anything else that you might have with your business that you're running alongside it, and just other life events such as buying your property or preparing for any inheritance that you wish to pass on to some of your loved ones. Okay. A few bits of work that we do for corporate entities. Okay, so new businesses in the first 5 years of running, you've got to sort of catch up with some of the benefits that some of your large competitors might be offering to potential employees. So that's having potential group life cover, for example, setting up pension schemes. We're now complied to set up pension schemes since 2016 from the first 3 months for an employee. And then also any other corporate benefits that you want to offer. So key person insurance and other bits and bobs like that. If anyone's got any questions, you can just wait to the end of the slide, just stick your hand up and we have a bit more of a social time here. Cool. There's a few bits about us and financial plans. Okay, this in itself changes quite dynamically throughout your lifetime, and that's the purpose of the presentation that we're going to have today. Okay, so Perspective, we've split that into 5 different stages, and what we're going to do is we're going to run through each stage, okay, and how that planning differs as you go through life. Okay, I've just got a little bit of quote there. So, first of all, 18 to 35, this is when someone really starts getting their independence, and unfortunately school doesn't teach you how to manage money. If anything, it might be a half-hour seminar with a guest speaker. Okay, right at the beginning of working, you're going to have a regular surplus of cash. You're going to have very little outgoings. Apart from going to the pub on a Friday night, there's not loads really to have to spend your money on quite regularly. Okay, and what you do with this surplus of cash, particularly at this stage in life, can be really important, and it's quite hard to explain that to a young person who's got a wad full of cash in their pocket. Okay, it's worth being able to research what they do with this money. Okay, that in itself, there's not enough time to go through in this presentation, but we're just in the corner, just by the toilets, unfortunately, in Hangar 1. So come say hello and we can run through this a bit later if you're interested. Okay, so school is finished, this person's legally become an adult, and some of the important skills that these kind of people need to learn is firstly how to budget, making sure more money is coming in than is going out, working out how income tax, understanding what's on the pay slip, what that means and where your money is actually going. Okay. If we can start a regular form of saving, this is a fantastic habit that can take you all the way to the end of retirement, and a real good skill to have. Unfortunately, a lot of people just learn this far too late. Okay. Especially in the past 10 years, we've had the access to easy debt. That's absolutely fun. Easy access to debt and credit has been quite critical for young people, and it's really adversely affected them. The number of young people with credit card debts they just cannot pay can really put you behind you up to 5 years in your life after you end up paying them off. Okay. So when we talk about wills and lasting power of attorneys, this is usually what people think of when they get a bit older. You know, they're starting to worry about death, and it's not an easy topic to have. But in my opinion, it really can't be done early enough. As soon as you've got assets, it's really important that you get to decide where that goes when you pass away. Okay, death unfortunately comes to us all, whether we're young or whether we're old. And having a will is critical. Otherwise, you're bound by the laws that the government says where your money goes if you don't have a will. Now, lasting powers of attorney, most people aren't too familiar with this compared to a will, but essentially the way it works is if one loses capacity to make decisions about their finances of their health, you can assign a person to do that. And again, a lot like a will, people typically think this happens, you know, in the later years, you know, with dementia and old age catching up on this. But losing capacity can happen to anyone. You know, I could drive home and have a car crash on my way back from today. Okay, and that's why it's important to be able to have someone who's trusted to manage those real important affairs for you. And this is why it's at the first stage, in our opinion. Okay. Ages 35 to 50. I think this is a little bit more relevant to us in the room. A lot more responsibility. Typically, this is the age that people start having children, purchasing homes, having a mortgage. The average age of a first-time buyer at the moment is 36. So it's a lot later than it traditionally has been, but it's understandable given the current climate. Again, going back to the tough times, it's not nice to talk about, but I think it's really important that it is considered. Okay, so life assurance, income protection products and critical illness are valuable tools of financial planning, and it's really important to have an expert guide you through this process, because we don't want, unfortunately, a death or a critical illness to affect one and it not be set up correctly. There's no point in doing it, in my opinion. You see the adverts where you set up life insurance for £6 a month, but if that doesn't cover any the mortgage or any potential debts that you might be leaving a loved one, then it's money thrown away, in my opinion. Okay. This is also the age that most people are able to build up their emergency fund. 3 to 6 months monthly expenditure is what we recommend. So if see what you're spending every month, times it by 3 to 6, and that's a really good sized pot to be able to cover any emergency costs, whether that's car, house, medical bills, etc. Okay. Once you get past 3 months, if you're still in financial trouble, that's where products like income protection can come in. They get a lot cheaper if you defer the payment for 6 months or 3 months, and they come a lot more affordable. And then we also look at where any additional savings. If you've got money at the end of the month, what should you do with it? Leave it as cash, invest it. There are a lot of adverts and there's a lot of information out there on what you should do with it. And there's nothing I'm saying today that you can't go away and Google. However, all the correct information is out there. The tricky bit is it's alongside all the wrong information as well. And so that's where us as financial planners come into the picture, and we filter out the noise and we make these plans for people. Onwards, there's a few other bits here, referring back to previous slides. So again, if we can keep the will, organise lasting power of attorney, ensure that you've got a competitive pension contributions coming from your employer if you are employed, and then if you're fortunate enough to be in a position where you're earning higher rate tax, so you're paying high rate income tax, you also benefit from the tax relief on any pension contributions that are made. So if you put £100 into a pension, you rather than getting £20 back, you're going to get 40. And 45 if you're fortunate enough to be in a position where you're additional rate taxpayer. Any questions so far? I could just go on and on and on. So unless someone stops me, I'm going to keep going, okay? Okay. Another cheesy quote. I didn't write it. Okay, I want to make that clear. All right. 50 to 60. Now, it's actually quite sad to say this is sort of the average age of the kind of client we have come towards us and gets in touch for the very first time. And unfortunately, it can be too late for some people. Okay, you can't make up in 5 years retirement contributions to make up for the previous 30 years. Okay, and that can be a real hard conversation to have. Typically, this is going to be the point where once we're making the most of their money, okay, we've got children or teenagers, even worse, that are driving us mad. Okay, you might be having issues with looking after elderly parents. That's a concern, and then we're also looking into higher values of assets, okay? And the higher the value of those, the more tax complications that come into it, whether that's capital gains or stamp duty, etc. This can be really, really key decisions that you need to get right to avoid quite large tax bills, okay? So as we said, that the two largest assets are going to be the pension fund and the house, okay? So including those in any financial plan are going to be really important. One thing I'll say at this point as well, anybody can make a financial plan. It takes an afternoon to do, okay? But to maintain it and to stick to it, it requires the ongoing servicing and just making sure it's still relevant to you. And just spending a half an hour, an afternoon looking into it, planning, seeing what you've got, checking what assets you've got in the bank, looking at your group scheme, seeing how much money you've got in your pension, yeah, that's better than nothing, okay? And then a few more points on 50 to 60. I think we covered most of that. We need to take these cheesy quotes out of this. I'm really not liking it. Okay, 60 to 75. This is the average age that people retire. They make that big jump from employed life to finding something to keep them busy with for the next 20 to 30 years. But financial planning doesn't stop at this point, okay? You spent your entire working lives leading up to this point, and so it's really important not to waste it, and knowing what's affordable to you, okay? As I said previously, people used to just buy an annuity. That'd be your guaranteed income, and it would sort of replace the employed income. The changes now, especially with pension freedoms in 2016, it means that, what's the polite way of saying this without sounding really young? Retirees, the elderly, I don't know the best way to put it, have got a big pot of money and they've got to be able to manage them themselves. And if people aren't too financially literate, it's going to be a really hard thing to do with people. And so it's being able to understand what's affordable when taking out those monthly, that monthly income, making sure that that pot of money doesn't run out. And a really interesting point about pensions is that they're exempt from inheritance tax. And so if somebody does have a large estate, okay, over a value of £1 million, the value of that pension will be exempt from inheritance tax. So it'll dodge the 40% bill on that. So if somebody does have an inheritance tax concern, maybe it's best to take out some sort of other way, you know, whether that's ISAs that have been built up or even equity release as an option to people, you know. It's different for the individual. Okay, the two key factors for people in this age bracket are firstly going to make sure that the savings are protected from inflation. Now, this presentation was written in November, I believe it was, so the full impact of inflation hadn't really hit us, but we've had a couple of months to really see that inflation's here to stay and it's something that needs to be managed. Currently, if I'm not mistaken, inflation is currently at 10.2%. So that effectively means that any pot of money that you've got, the buying power is going to be 10.2% less than it was in the previous year if it stays at a flat rate. Now, we say investments for a moderate investor can expect to really make between 5 to 7% per year, on average over 10 years. So that's really concerning, and it's understandable why it's priority for the current Tory government to get inflation under control and halve it. Whether that actually happens remains to be seen, but it's really hitting people the hardest in the pockets. Okay. And as I said previously, the income needs to outlast you. There's no point getting to 90 and seeing that this pot of money's run out. The state pension's there for most people that have been employed. Currently is £185.15 per week, which works out to be, if I'm not wrong, about £9,800 per year. Okay, so because it's under the personal allowance, there's no tax bill on that. But if you have someone that's been very used to 30 grand a year, 40 grand a year, the pot of money runs out and they're back down to 9,800, that impact on one's standard of life can be quite dramatic. Okay. A few other points here that's worth looking at. If you've got people you're leaving money to, it's so important to have the conversation with your beneficiaries so they can plan for it themselves. What are they expecting to receive from you? They may spend their whole life thinking they're going to get a house or a pension scheme, and then if that's not the case, that can really be quite traumatic for one. And yeah, I think that's about it on that one. There we go. We'd much rather leave our estates to our loved ones rather than HMRC. Okay, and there's some really simple things that you can do to avoid this. As individuals, we get a series of benefits called nil rate bands. So this is a value of your estate that is exempt to inheritance tax. For each individual, it works out between both of them to be £500,000. If you're married and your spouse passes away before you, you take theirs. So essentially your estate can get to £1 million without having to pay a single penny of inheritance tax. Now, if you're fortunate enough to be over that £1 million bracket, there's still other things that you can do. We won't go into detail, but a few options are certain loan trusts, or business property relief is open to the individual, so that can increase the amount of money that you can pass on to your loved ones. And you don't have to wait until you pass away to do these things. You can give gifts whilst you're still alive, so you can see the benefit of your money helping your loved ones whilst you're still around, whether that's a deposit for a new home or paying for a wedding. There's certain tax allowances and reliefs that can make it a bit easier. As I've preempted myself and gone on to here. So, there we go. There. Okay, just seeing if there's anything I've missed. Oh yeah, it's worth mentioning that if you wish to donate any money to a charity or to a political organisation, I don't think politicians are too popular at the moment, so probably down to the charities it is. If you give 10% of your estate away to a charity or political party, the rate in which you pay inheritance tax drops down from 40% to 36%. Okay, so if you do want to leave a large lump sum to guide dogs, cancer research, Macmillan, etc., that can be a really tax-efficient way to do it. Okay, we're nearly at the end here. I know it's been a quick one, but we'll get out, enjoy the brief amount of sun that we've actually had today. And yeah, just summing up, financial planners, one thing that can really put someone off a financial planner is the cost and the charging structure associated with it. Because we're not, I'd openly admit, people aren't open with it. They don't explain how costs and charges work. But any financial planner worth their salt, they'll have the first meeting free of charge with you. Something that I say to my clients is, the first meeting, the only cost is a cup of tea and maybe a biscuit. Okay, we sit down, we have a chat, we discuss what you're looking for, what you're looking to achieve, and just from having that free meeting in itself can be so beneficial. Okay, and then you can take it on from there. Now, I know I've rattled through that. Okay, if anyone has any questions, please let me know. If not, we're just down by the gents in the corner of Hangar 1. So come say hello. We're here for a couple more hours. And yeah, thank you very much.
Thank you.